Bigbear.ai has been making waves in the stock market this year. Many investors are buzzing with excitement, hoping this company can follow in the footsteps of Palantir, a name that's become almost legendary in the AI-driven defense and data analytics space. The hype is real, but the big question is, does Bigbear.ai actually have the numbers and performance to back up that optimism? Let's take a closer look. Whenever a company is being compared to a giant like Palantir, the first thing I like to check is revenue growth. If a business wants to achieve long-term credibility and investor confidence, it must show consistent increases in demand for its technology and services. That's what drives valuation and excitement on Wall Street. Unfortunately, in the case of Bigbear.ai, the story isn't quite as bright as some people might think. Despite all the attention, the company's revenue trend has actually been flat to negative in recent years. Even with acquisitions meant to strengthen and expand its capabilities, we haven't seen the kind of organic revenue growth that would justify all the hype. In fact, Bigbear.ai reported $103 million in revenue over the most recent 12-month period. That's down from $158 million last year and down from $155 million in 2022. So, instead of trending upward, the company's top line has slightly declined over the past few years. And keep in mind, this includes periods when they spent heavily to acquire other firms. Normally, acquisitions should boost total sales, but even that didn't prevent a dip in their numbers. That alone raises some red flags for investors who were expecting big acceleration in revenue. Now, the company isn't sitting still. It has signed several new government and commercial contracts, and its technology is being used in airports and border security systems, areas that are growing more relevant given the current U.S. administration's focus on border control and national security. That initially sparked a lot of investor optimism. Many assumed these government priorities would mean more demand for Bigbear.ai's systems and data intelligence platforms. However, the company's most recent earnings report and conference call painted a more complicated picture. Management acknowledged that while Bigbear.ai benefits from some government contracts, it has also faced headwinds from policy shifts, particularly spending cuts and budget reallocations. In simpler terms, while government interest in AI and surveillance is high, the actual funding available to pay for those projects hasn't always kept up. This has led to contract delays and losses, offsetting some of the potential gains from new deals. So, despite being in the right sector, the timing hasn't fully worked in their favor. Let's talk about returns on invested capital, ROIC, one of the key indicators of how efficiently a company turns its investment into profit. Now, I don't mind when young, high-growth companies post negative ROIC numbers early on. That's pretty normal when you're building a long-term business. But what's important is the direction. Is it improving over time or getting worse? Bigbear.ai actually showed progress at one point. Back in 2021, its ROIC was about negative 28%, and by 2024, it had improved significantly to around negative 12%. That's a solid trend. At least it was. Unfortunately, the latest data reversed that progress. Over the most recent 12 months, the company's ROIC fell again to around negative 15.3%, signaling a backward slide in efficiency and profitability. And based on what management has said, this could deteriorate even further. During their latest conference call, the team made it clear that they plan to ramp up spending aggressively. Their goal is to reignite revenue growth after several stagnant years. On one hand, that ambition sounds exciting. On the other hand, it means they're willing to sacrifice near-term profitability for the chance at faster top-line expansion. It's a gamble. More spending doesn't guarantee growth, especially if the core demand for your product hasn't yet proven to scale organically. So, while the company hopes this strategy pays off, it will likely push its returns and margins deeper into the red in the short term. The management also mentioned that they're open to additional acquisitions, another risky move if not handled wisely. History has shown that many companies tend to overpay for acquisitions, overestimating the benefits or synergies they expect to gain. Only a few companies like Broadcom have consistently made smart, value-accretive deals. But plenty of others, Salesforce comes to mind, have ended up with acquisitions that looked great on paper, but failed to deliver strong returns. If Bigbear.ai follows the wrong examples, it could dig itself deeper into financial inefficiency. Now, let's address something that many retail investors are probably wondering: the stock's valuation. I know Bigbear.ai is a popular ticker on social media and trading forums. It's an AI stock, and at less than $10 a share, it feels accessible. almost like a lottery ticket for those who believe in the future of artificial intelligence. Combine that with the Palantir comparison, and it's no surprise that a lot of smaller investors are hoping for explosive upside. But here's the thing. When you crunch the numbers, the stock looks significantly overvalued. Based on fair value calculations, Bigbear.AI's intrinsic worth comes out to around $1.31 per share, yet it currently trades at about $7.52. That's more than 5 times its estimated fair value, a huge gap that's hard to justify given the company's lack of growth and inconsistent profitability. In other words, it's already priced like it's a major winner, even though it hasn't proven that yet. That's the opposite of what value investors look for. To summarize everything, Bigbear.AI absolutely has potential. There's no denying that. It operates in one of the most promising sectors of the decade. Artificial intelligence, data analysis, and defense technology are all critical areas of the modern economy. But the company faces serious challenges before it can truly live up to the hype. Its revenues are not accelerating, its margins are still negative, and its management strategy depends heavily on spending more money to chase growth rather than focusing on efficient execution. Add to that an already inflated stock price and strong investor enthusiasm, and you've got a setup where expectations are sky high. But the fundamentals don't quite match. This isn't a hidden gem that Wall Street has ignored. It's a company that's already loved by many investors, perhaps a bit too much for where it currently stands. So where does that leave us? Personally, I'd categorize Bigbear.AI as a hold right now. That's the stance I've updated as of October 10th, 2025. It doesn't mean the stock can't explode. Anything can happen in the short term, especially in volatile markets. But in terms of long-term investing, the risk-to-reward balance just doesn't look favorable at these prices. Until we start to see clear, consistent revenue growth and a real turnaround in profitability, it's hard to justify jumping in at today's valuation. This is not financial advice.